I'll be damned. Take a look at that. The bulls got rug pulled today. The NASDAQ gapped up in pre-market. You were up almost 1% to start the trading day. Now, at the time of recording this video, you're down almost 1.8% on the NASDAQ. That is an incredible turn of events. Here in this video, I have all of the news that you need to know surrounding this drop today in our markets and just how bad this could get. Keep in mind, I do not take sponsorships from sketchy partners. The only thing I ask you to do here on this channel is hit the like button and subscribe to the channel because it's free 99 and costs you absolutely nothing at all. And let's go ahead and get started. So I think we should start with the gap up, what happened today. Essentially, there was two things that happened. The markets were like, oh my gosh, there's no retaliation from Israel. Things are great. The world can get back to what we were doing. It's over. Well, not so fast. According to Israel's Army radio, citing a Wall Street Journal report that says Israel's attack on Iran can start as early as today, per a U.S. official. There were also many other outlets that also confirmed this. This came after about 7 hours ago, the Israeli War Cabinet said they were still debating on how to respond to the Iranian attack. And now, according to an Israeli official, a response to the Iranian attack may be imminent. This is quite the opposite of the news and overall opinion we had to start the trading day, and all of that just got thrown out the window. And it looks like this geopolitical back and forth rug pull, tug of war, whatever you want to call it, with Iran and Israel is likely far from over. Now, as I have explained many times, this specific situation with Israel and Iran is a little bit different than Hamas. It's a little bit different than other tensions you've seen around the globe because of the impact potentially on oil. If there were to really be a conflict between Israel and Iran, the Strait of Hormuz is the biggest choke point of oil in the world. 30 to 45% of the world's oil supply flows through the Strait of Hormuz every single day. This is an interactive chart of the global oil tankers. And yeah, you can see most of them are flowing through the Strait of Hormuz in one direction or the other. Here is Iran right here. They've already seized a container ship belonging partly to the Israeli government and partly to an Israeli family. And odds are, well, you could see a lot more of a, I want to say, quote unquote, blockade or just a slowdown of traffic through this region. Just like you've seen with the Red Sea here with the whole Yemen debacle, well, transport had to go around Africa. And there's really no other way to get oil out of here unless you were to go all the way through Saudi Arabia and through the Red Sea, and that would be a disaster across the board. That could be very inflationary to the price of oil, which could also be inflationary to the price of gasoline at the pump. This is bad for inflation. If you think about anything you have in front of you, these one-a-day vitamins, these crackers, this Arizona tea, which is my favorite, by the way, all of this was transported to the store in which I transported to get there and took these products home. Okay, well, these came from Amazon, full transparency. But still, oil was involved in all of that. That is an input cost that puts pressure on margins for companies. Companies don't like to see their margins erode. They tend to pass on prices. That can be very inflationary. But gas prices at the gas pump going up as well, well, that hurts economic activity. So higher inflation, weaker economy, nothing the Fed can really do for high inflation. That begs the question, should they just cut rates, right? If the economy is starting to feel a big drag because of the price of gas, should they cut rates and just forget about this oil shock inflationary pressure? Because after all, there's nothing they can do about it anyways. Or do they stay higher for longer, even though there's nothing they can do about it anyways? It really puts the Fed in a bad situation. Now, I don't know if we are truly going to see an oil shock, but judging off of Israel's actions and what Iran has said, this conflict could get a lot worse before it gets better. And that would definitely cause an upside, pressure on oil. In fact, we actually had good news in the beginning of the trading day, partly why the NASDAQ gapped up. You had retail sales that came in month over month at 0.7%. The forecast was 0.4%. Last month, you came in at 0.6%. So you were expecting a slowdown month over month in retail sales. You actually came in higher on a month over month basis. That's fantastic because the only bull thesis for stocks right now is earnings are going to come in better than expected. You can't really expect multiple expansion if the Fed, if we went from pricing in 6 rate cuts to start 2024 down to 2, maybe 1, maybe no rate cuts in 2024. It's hard to make a case for multiple expansion in this market environment when multiples are already 21 times. That's expensive, at least for the headline S&P and the NASDAQ. Obviously, the higher multiples are really in your big tech names. If you exclude Magnificent 7 stocks or Mag 6, whatever people are calling it today, then multiples are a lot more reasonable, sitting at about 15 to 16 times. But looking at the S&P and the NASDAQ broadly, you're not going to expect to see multiple expansion there. So you have to count on earnings coming in higher than expected. And then, well, whatever the earnings are, let's say 250 times 21, and that's where you get the S&P that could potentially go higher from here. Oh, that's huge. 250 times 21. That's where you could see the S&P at, 525 on the SPY or 5,250 on the SPX. But if there is this rapid rise in gas prices at the pump, that's going to really put a blocking on people's spending power. Considering the average family spends a little over 10% of their disposable income, which I wouldn't even call it disposable income. I would call it a necessity on gasoline. And that's why the markets are selling off today. And the problem here is this is a lot of uncertainty. We don't know where things are going to go next. Usually uncertainty is worse than the actual news itself. Usually the news itself, upon any geopolitical tension, the markets kind of eat it up. They buy it up, just like you seen this morning in pre-market. Before retail sales even came out, you seen markets doing well. Well, the uncertainty was gone. Now it's back. And what do you see? The NASDAQ's down 1.7%. And in the backdrop, you have your earnings season starting, which so far has kind of been a mixed bag. We'll see what Netflix says on Thursday. TSMC also says on Thursday. And ASML coming on Wednesday. But so far, higher inflation, less accommodative Fed, better economic activity, which is good, but means a less accommodative Fed, and these geopolitical tensions with high market valuations. I'm not super excited about where stocks could go from here. Now, we did get some good news here in pre-market as well that caused part of this gap up in the NASDAQ. Fed Williams was giving a speech and he says, "My own view is that rate cuts will likely start this year." He also goes on to say, "I don't see the recent inflation data as a turning point." And finally, he thinks the economy will continue to grow at a solid rate. All of these comments are pretty dang dovish and pretty much in that sweet spot of Fed's gonna cut rates, economy's gonna be good. All is fine in markets. But there are some fund managers that are starting to question whether the Fed could surprise the markets with a cut soon. Which honestly, given everything we've talked about here in this video, a cut at this point would make sense. Jerome Powell is begging for a reason to start cutting rates. Give him this geopolitical tension. Give him an oil price shock that, could have very negative impacts on the economy. And that could just be the reason he's been waiting for, to start cutting rates. I have shown this here on the channel before, but whenever you're going into recession, a lot of the times you do see a spike in oil right before that. And a lot of people see this as, what could be the last blow off top rally in oil, the last blow off top, spur in economic activity. For one reason or another, when you do get a spike of gas prices, oil prices, you tend to get a weakening economy. Most notably, this happened the year of 2007 through 2008, where you went from, where we pretty much are at about $85 a barrel, up to a high of $140 within the course of Most of this happened within about 3 months. You went from 101 to 140. And then, by the beginning of 2008, when you peaked out, yeah, you were in a deep economic problem at that point. If the Fed starts to forecast, maybe there's going to be an oil price shock, that would be justification that the Fed is looking for to start cutting rates. Also have some pretty aggressive tightening happening in the bond market recently. 10-year treasury yields are up another 13 basis points today. That's the equivalent of the Fed basically giving you half a rate hike. And just to start 2024, 10-year treasury yields have went from, sheesh, it's crazy to even think, have went from about 3.86% to 4.62%. That's almost a 1% move higher in 10-year treasury yields just in the first 4.5 months of 2024. So that's another reason the Fed might want to say, hey, we want some restriction on the economy. But if core PC inflation is 2.8%, and the federal funds rate's 5.25%, 10-year treasury yields are even 4.62%, you could cut rates 4 times and still be 1% restrictive on the economy as per kind of standard economic practices. Once you get the federal funds rate above the rate of inflation, you start to be restrictive, right? So you're very restrictive, especially as the 10-year treasury yield continues to rise. Yeah, you can make an argument. The Fed may actually think about cutting rates if this situation spirals further. Let me tell you, the only thing worse than being late to raise rates when inflation hits is to be too late to start cutting rates and to have your legacy be the guy that got it wrong from the start and to be the guy that got it wrong at the end to push the economy into recession. During an election year, I don't think so. You're already having government officials calling on Jerome Powell and different Fed governors to start lowering rates. And this could be just the excuse that they've been waiting for. Now, obviously, these are hypotheticals. I don't want to jump to conclusions, but if this situation did spiral, especially if there was an implication to energy markets and really gasoline at the pump, that's what I'm talking about here. That would cause more economic restraint across the board than all of what the Fed has done so far. The Fed's tools are good for affecting lending, housing, autos, anything financed, but it's really bad at affecting whether or not you go to a Taylor Swift concert, whether or not you go to a football game, in which the Lions football games were $5,000 a piece, a couple $1,000 per ticket, depending on what game you were trying to go to. It's really bad in affecting those things. But let me tell you right now, if gas went up, that's really good at affecting those things. So I don't want to, again, jump to conclusions. But if this situation does spiral, it's possible you could start to see the Fed cutting rates a lot sooner than what the markets are expecting. And I don't want to paint that as a good thing, because if the Fed is cutting for the wrong reason, that's not good for stocks. So have earnings coming tomorrow with Bank of America, United Health Group, Johnson & Johnson, Morgan Stanley, BNY Mellon, PNC, and others. Tomorrow and after hours, United Interactive Brokers, JB Hunt. Wednesday pre-market, this is your first kind of important earnings. It is ASML. That is a high-flying AI semiconductor name. If they have disappointing numbers or disappointing guidance, I think there's really not much these AI companies can say that's going to impress investors right now. Let's be honest. These stocks are priced for perfection. Well, if they have bad earnings, that's a problem for our markets. That's kind of the bottom line. Wednesday and after hours, Alcoa, Las Vegas Sands, Kinder Morgan, Discover will report. Thursday pre-market, TSMC, very important name there. Nokia, Blackstone Group, KeyBank, Alaska Airlines, Ally Bank. Thursday after hours, Netflix, Intuitive Surgical, PPG, Western Alliance Bank Corporation. Obviously, Netflix, by far the most important name for this week, but others will be important as well. You also have American Express and P&G as well, Friday pre-market. And again, kind of as a backdrop to this, I think expectations are way too high heading into this earnings season. I think no matter what companies report, it's going to be seen as a disappointment. Unless you give Nvidia-like guidance, how are you going to impress investors when a stock like ASML has went from, November lows of about $560 to where it is now at $955. You've priced in a lot of good news. Or TSMC. I mean, same thing there. You've priced in a lot of good news there. The stock's at $140. The lows in November, the stock was sitting at $87. I mean, how are you going to impress investors? I find it very hard to believe that good news is not already priced in to such a degree that even meeting expectations is not good. Same with Netflix. I mean, back in October, November of 2023, the stock was $330 or so. Today, it's $605. Like, you are probably set up for failure regardless of geopolitical tensions. Now you have this situation on our hands. And yeah, things could get worse. As I have said before, I'm not going to change my initial estimates. I do believe you can expect to see a 7 to 10% pullback. You have decisively broke under your 50-day moving average today. This is problematic in and of itself. This is the first time you've been under the 50-day moving average since back here November 2nd of 2023. So that's bad news. Next stop is that 100-day moving average. I find that likely, and that's going to be at about 420.63 on the NASDAQ. If things do get really bad from here, then you fall to about 390. If earnings are bad, you could fall further, or if the Fed were to do some kind of surprise rate cut, then you could fall even further than that, and you could probably retest those October, November lows. But that would really come, geopolitical tensions come to a head, earnings come in worse than expected, and maybe the Fed cutting rates unexpectedly. That's what takes you back to there, because even, I mean, if all of that happened, that would still be a drop from here of about 21%. So that would be a huge drop to get back to those October, November lows, but it's definitely possible. And the markets, they're not even looking at it as a possibility. So I think this is the exact moment in time you want to be way more conservative and defensive than most of your bulls out there on Wall Street. Hit the like button, subscribe to the channel. Let me know what you think about this information down below in the comment section. You guys have a fantastic rest of your day, and I will see you in the next one.